Maybe you've got a bit of cash stashed away, not the buy a mansion kind, or you're starting from ground zero and are a complete newbie to this investing thing. You're now starting to think, hey, it's time my money starts pulling its own weight. Stocks, bonds, real estate, crypto, artwork, index funds, commodities, the list goes on. And yeah, I know you've seen those flashy ads promising quick bucks with day trading or Forex. But let's be real, the thought of your hard-earned money vanishing into thin air? Not so appealing. So here we are, cutting through the noise to bring you the ultimate guide to investing for beginners. We're breaking it down into chunks: philosophy, practical steps, smart strategies, and pitfalls to dodge. And don't worry, we've got timestamps, so feel free to jump to what interests you most. If you make it to the end, I will share one type of investing that people don't talk about enough. It could grow your wealth exponentially. Ready to turn those savings into earnings without sweating over potential losses? Let's get into it. So, you've decided to start investing, but before you even think about buying stocks or exploring real estate options, let's talk about getting your financial house in order. It's the essential groundwork that's going to support every financial decision you make from here on out. Starting with debts, especially those high-interest credit card balances that gnaw away at your finances. Imagine you have a $5,000 credit card balance with a 20% annual interest rate. Each year, that's $1,000 eaten away by interest alone. By paying off this debt, you're essentially earning a 20% return on your money. There's no investment in the market that can promise that return risk-free. So tackle those debts aggressively. It's the smartest investment you can make initially. Next up, emergency funds. Why are they so important? Life is full of surprises, some less pleasant than others. Without an emergency fund, you could be one car breakdown or medical emergency away from financial distress. The goal is to have a buffer, ideally 6 months' worth of living expenses. Say your monthly expenses add up to $3,000. You should aim to have at least $18,000 set aside. This isn't just being cautious, it's strategic. Having this buffer means you won't be forced to pull out your investments at the worst possible time. So you should sit down and comb through your finances. What debts do you have? What are their interest rates? Make a list and prioritize them by interest rate, paying off the highest ones first. After that, budget for your emergency fund. Look at your budget. Where can you cut back? Maybe it's eating out less or skipping that extra coffee. Every little bit helps in building that emergency fund. Then automate your savings. Set up a direct deposit from your paycheck to a separate savings account. If you don't see the money, you're less likely to spend it, and it will grow quietly in the background. Look for high-yield savings accounts. In the US, SoFi, Citizens, and Discover offer some, and in the UK, I like Monzo for their tech. Barclays, Nationwide, and Skipton's offer good options too. It's important to do your research on these and base it on your circumstances and geographical location. Once your high-interest debts are cleared and your emergency fund is on track, you're ready to think about investing. These steps aren't the most glamorous part of the investment journey, but they are by far the most critical. By ensuring you're not paying exorbitant interest rates and you have a financial cushion, you'll be in a position to invest with confidence, focusing on growth without the stress of financial vulnerabilities lurking in the background. Remember, this isn't about putting off investing. It's about investing in your financial health first, which is the bedrock of all future investment success. Now let's understand what investing is and why people actually invest. Think about investing like planting a seed. You put that seed, your money, into the ground, the market, and over time, with the right conditions, it grows into a fruitful tree. That's what investing is at its core, putting your money to work so it grows over time. It's how you build your wealth, not just by saving what you earn, but by earning more on what you save. People invest for all sorts of reasons: to secure their future, to grow their wealth, to generate income, or to save for specific goals like buying a house or retiring comfortably. Some want to leave a legacy for their kids, while others might be looking to fund a dream project or charity work. There's also inflation. It's like the silent dinner guest who subtly takes a bite of your savings without you noticing. Over time, it can eat away the value of the money you've worked so hard to stash away. That's why stuffing your cash under a mattress might not be the best idea. Sure, it feels safe, but it's not doing anything for you. In fact, it's losing power, the power to buy stuff, as inflation marches on. Think about it. A loaf of bread costs more today than it did 10 years ago. That's inflation for you. It's the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If your money isn't growing at least as fast as inflation, you're effectively losing wealth. This is where investing comes in as a shield. By investing, you're aiming to increase your money at a rate that not only keeps up with inflation but surpasses it, increasing your purchasing power over time. In essence, investing isn't just about growing wealth, it's also about preserving it. By carefully choosing where to put your money, you're not just hoping to make a few extra bucks. You're ensuring that the money you have today will be just as powerful, if not more, in the future. It's about making sure that when you reach into your wallet 10 years from now, you'll be able to afford not just the loaf of bread, but maybe the whole bakery. Now let's talk about the different types of investing, because it's not just one size fits all. There's stock market investing, where you buy a piece of a company, and if the company does well, so do you. Bonds, on the other hand, are like loans you give to companies or governments, and they pay you back with interest. Real estate investing might involve buying property to rent out or sell at a profit. This has a high barrier for entry, as you can imagine. Then there's investing in mutual funds or index funds and ETFs. These are baskets of stocks or bonds that let you diversify, spreading your money across many different assets. So why do people invest in different things? It's all about goals, timelines, and risk tolerance. Younger investors might skew toward stocks for long-term growth, while those nearing retirement might prefer the stability of bonds. It's all about finding the balance that works for you, and that's the heart of investing. It's personal. Investing isn't about getting rich quickly. It's about setting the stage for long-term financial success. It's a marathon, not a sprint. And the sooner you start, the more you stand to gain. It's empowering, it's accessible, and thanks to the internet, it's easier to get into than ever before. In this video, we will focus on investing in stocks and shares, since this is generally the easiest way to get started investing. If you understand the concept of the stock market, you will be well on your way to investing success. Investing in stocks is essentially buying shares in companies. When you own a stock, you own a piece of that company's assets and earnings. If the company grows and becomes more valuable, so does your share. Stock prices fluctuate based on supply and demand, influenced by the company's performance, market conditions, and economic factors. Now let's talk numbers. Say a company has 100 shares and you buy one share for $10. If the company performs well and its total value doubles from $1,000 to $2,000, your share would also potentially double, now being worth $20. But remember, this can go both ways. If the company's value halves, your share could decrease to $5. Now, if you know about how business works, you will understand that sometimes businesses do well, and sometimes they don't. The challenge then becomes, how do you decide what companies to own a piece of? Here comes index funds and ETFs. Index funds and ETFs provide an avenue to invest in a broad chunk of the market without the need to meticulously select individual stocks. An index like the S&P 500 represents the market's performance by including a mix of 500 of the largest U.S. companies. When you invest in an S&P 500 index fund or ETF, you buy a small portion of those 500 companies. This diversification helps mitigate risk, as you're not exposed to the failure of a single company. The benefit of index funds lies in their historical performance. Over the last 90 years, the average annual return of the S&P 500 has been about 9.8% before inflation. If you invest $1,000 in an S&P 500 index fund, after 1 year, you might expect an average increase to about $1,098. Over longer periods, the compounding effect amplifies this growth, although past performance doesn't guarantee future results. The lower fees associated with index funds also mean more of your money is invested working for you rather than paying fund managers. An actively managed mutual fund might charge 1% or more annually, whereas an index fund often charges less than 0.1%. On a $10,000 investment, this difference in fees could save you $90 or more every year, which over decades can significantly affect your investment's growth. So how do you start investing in index funds and ETFs? First, it's important to understand the differences between index funds and ETFs. Although they come under the same umbrella, there are important differences. 1. Trading mechanism. Index funds. These are a type of mutual fund that you buy and sell directly from the fund provider, typically at the end of the trading day based on the fund's net asset value, NAV. ETFs. These trade like stocks on an exchange, meaning you can buy and sell ETF shares throughout the trading day at market prices, which can fluctuate throughout the day. 2. Investment minimum. Index funds often have a minimum investment requirement, which can range from a small amount to several $1,000s. ETFs can be bought in increments of a single share, which makes them accessible even if you have a small amount of money to invest. 3. Expense ratios. Index funds. These may have slightly higher expense ratios than ETFs, but this is not a rule and can vary widely between providers. ETFs tend to have lower expense ratios, partly because they are structured to be more cost-efficient. 4. Index funds can generate capital gains distributions as they buy and sell stocks within the fund, which can be taxable events for the investor. ETFs are generally more tax-efficient due to the in-kind creation and redemption process, which typically does not generate a capital gains tax event. 5. Dividend reinvestment. Index funds often automatically reinvest dividends for you, which can help compound growth. ETFs may not automatically reinvest dividends. This depends on the brokerage and sometimes requires manual reinvestment or enrollment in a dividend reinvestment plan. 6. Share pricing. Index funds. Investors buy and sell shares at the NAV, which is set once per day after the market closes. ETFs, shares are priced in real time throughout the trading day, which can lead to prices that are above or below the NAV, premiums or discounts. In essence, the choice between an index fund and an ETF can come down to personal preference, investment goals, and trading flexibility. Index funds may be preferable for those planning regular investments through automatic contributions, while ETFs can be more suitable for those interested in more tactical intraday trading strategies or those seeking lower minimum investments. If you're finding value in this video and it's lighting up some light bulbs for you on how to get started with investing, I'd love for you to smash that like button. It tells me what content you enjoy and helps more people find these resources. And while you're at it, consider subscribing to the channel and hitting the notification bell so you won't miss out on any future videos designed to help you build a stronger financial future. Your support means the world and fuels more content like this. Before you get started picking what index funds or ETFs you invest in, there are some important terminologies to familiarize yourself with. Accumulating versus distributing funds. Accumulating and distributing refer to how investment funds handle the income, like dividends or interest they receive from the assets within the fund. Accumulating AC funds. These funds reinvest any income they receive back into the fund. This means that the value of each share or unit in the fund increases to reflect the reinvested income. For investors, this means that while they won't receive periodic income distributions, they may see a more rapid growth in the value of their investment since the dividends are automatically reinvested to purchase more assets within the fund. Distributing DIST funds. In contrast, distributing funds pay the income they receive out to investors as dividends or interest distributions. This can provide the investor with a regular income stream from their investment. The value of each share or unit doesn't increase from reinvested income since that income is being paid out. The type of fund is usually indicated somewhere in the key investor information or the fund information page of your investing platform. 2. Differences in ticker symbols. This is one that can be confusing. The ticker symbols are essentially codes created to give traders and investors a quick way to identify a particular fund, and the symbols can vary significantly from one market to another. It's important for you to ensure you are looking at the correct ticker for your country or investment platform to avoid any confusion, especially since the same fund may have different tickers in different markets. Ticker symbols can differ from country to country due to different exchanges and regulatory environments. In the US, tickers are typically 1 to 5 letters and can include numbers. For instance, the ticker for the Vanguard S&P 500 ETF is VOO on the New York Stock Exchange. Outside the US, tickers often include a mix of letters and numbers that may also indicate whether a fund is accumulating or distributing. For example, a Vanguard S&P 500 ETF might have a ticker like VUSA, distributing, or VUAG, accumulating on the London Stock Exchange. There are also suffixes. In some cases, the ticker symbol will have a suffix that indicates whether the fund is accumulating or distributing. For example, an accumulating fund may end in ACC, whereas a distributing one may end in DIST. By choosing to invest in index funds and ETFs, particularly as a beginner, you're embracing a strategy that seeks to mirror the market's broad performance, offering a balance between risk and return while keeping costs low. It's a practical starting point for building a diversified portfolio. 3. Investment platforms. These are also known as brokerage platforms. They are like the gateways to the world of stock market investing. They are online services that allow individual investors to buy and sell various investment vehicles such as stocks, bonds, and funds. Platforms like Trading 212 have made investing more accessible than ever before. You can start with as little as $1 in some cases. To start, you would create an account with Trading 212 or any other brokerage platform. This involves providing some personal information, verifying your identity, and linking a bank account. This process is typically done online and can often be completed in a matter of minutes. Once your account is set up, you would deposit money into it, much like transferring funds to a checking or savings account. The time it takes for funds to become available can vary by platform and deposit method. With funds available, you can then navigate to the trading interface of the platform. Platforms like Trading 212 usually have a search bar where you can type the name of the fund you're interested in, like Vanguard S&P 500 or BlackRock S&P 500. It is important to mention that I do not have any affiliation with Trading 212 at this time. It's simply the platform I use and will recommend to anyone looking to start investing. When you find the fund, you can proceed to buy shares in it. You'll be presented with options like buy and sell. If you're investing, you're interested in buy. You can choose to buy a specific number of shares or to invest a specific amount of money. For instance, if you have $500 to invest and a single share of the Vanguard S&P 500 fund costs $250, you can either purchase 2 shares directly or invest the $500 and buy shares equivalent to that amount, which would be 2 shares in this case. Many platforms also offer the option to set up regular investments. You could instruct Trading 212 to automatically invest $50 in the Vanguard S&P 500 fund every month, for example. It's important to be aware of any fees or charges. Trading 212 advertises commission-free trading, which means you won't be charged for each buy or sell order. However, it's crucial to check for other potential fees, such as currency conversion charges if you're buying funds in a currency different from your deposit currency, or annual platform fees. If the S&P 500 fund you've invested in pays dividends, these will typically be paid into your brokerage account. You can then choose to reinvest these dividends to buy more shares or withdraw them as cash. When the time comes to sell your investment, you would simply place a sell order through the platform, specifying how many shares you want to sell. The funds from the sale will go into your brokerage account, from where you can withdraw them to your bank account. Platforms like Trading 212 also provide tools for tracking the performance of your investments. You can see how the value of your S&P 500 fund shares has changed over time and calculate your returns. By investing in a tracker like the Vanguard or BlackRock S&P 500 fund, you're essentially buying a small piece of the top 500 companies in the U.S. market, diversifying your investment and minimizing the risk that comes with picking individual stocks. And using platforms like Trading 212 simplifies the process, making it straightforward even for those new to investing. Investing in index funds and ETFs is often seen as a wise approach to building wealth over time, but it's essential to understand that this strategy is not a shortcut to riches. Rather, it's a method grounded in the principles of patience, diversification, and the power of compounding returns over the long haul. Index funds and ETFs are designed to mirror the performance of a market index. Because these funds are typically diversified across many different securities, they are less likely to experience the dramatic ups and downs associated with individual stock investments. This means that while you may benefit from the steady growth of the market, you're unlikely to see the kind of rapid gains that can be touted by high-risk, high-reward investment strategies. The beauty of index investing lies in its simplicity and the compounding effect over time. For example, the historical average return of the S&P 500 index has been about 7–10% per year over the long term. While this can lead to substantial growth, it requires a long-term perspective and a commitment to staying the course, even during market volatility. Furthermore, index funds and ETFs often come with lower fees than actively managed funds, which can eat into your investment returns. Over time, these lower fees can make a significant difference in the growth of your investment. In summary, while investing in index funds and ETFs can be a solid part of a long-term financial strategy, it's not a get-rich-quick scheme. It's about making informed, disciplined choices, with a focus on long-term financial health and stability. It's for those who understand that investing is more akin to running a marathon than a sprint, valuing steady progress over speculative gambles. Navigating the investment landscape can be tricky, and even with a straightforward strategy like index funds or ETFs, there are pitfalls that can trip up investors, new and seasoned alike. Let's go over some common ones to keep your investment journey on the right track. First, there's the pitfall of emotional investing. The market is like a roller coaster. It has its ups and downs. Getting caught up in the excitement of a high market can lead to overinvesting at peaks, just as letting fear take over during a downturn can cause you to sell at lows, potentially locking in losses. The key is to stay the course and remember your long-term strategy. Another common misstep is neglecting to diversify. While index funds and ETFs are inherently diversified, some investors make the mistake of not spreading their investments across different types of assets. It's wise to have a mix that might include bonds, international stocks, or even alternative investments like real estate to balance out the risks. Falling for the allure of timing the market is yet another pitfall. It's tempting to think you can buy low and sell high based on predictions, but even professional investors can't consistently time the market successfully. A more reliable approach is regular, disciplined investing, what's known as dollar-cost averaging, where you invest a fixed amount regularly, no matter what the market is doing. Overlooking fees is a subtler pitfall that can erode your returns over time. Even small differences in fees can add up, so it's important to understand all the costs associated with your investments, from fund management fees to transaction fees. Lastly, there's the risk of inaction. Paralysis by analysis or waiting for the perfect time to invest can be a pitfall in itself. The market will never send a clear signal that it's the right time to start investing, so rather than waiting for the perfect moment, start with a solid, well-considered plan as soon as you're financially ready. By steering clear of these common pitfalls, emotional investing, lack of diversification, trying to time the market, ignoring fees, and hesitating to start, you'll be better positioned to maintain a healthy investment portfolio that grows over time. When we talk about investing, the conversation often revolves around stocks, bonds, and real estate. But there's a facet of investing that doesn't get nearly enough airtime, and it's arguably the most crucial one: investing in yourself. Investing in yourself is about more than just self-improvement. It's about enhancing your value in the marketplace, broadening your skill set, and increasing your potential for earnings. This can take many forms, such as pursuing further education, attending workshops, acquiring new certifications, or even picking up books that expand your understanding of financial literacy and personal development. Investing in yourself is a broad concept that encompasses any action you take to improve your own skills, knowledge, and well-being with the aim of enhancing your life, including your earning potential. Here are some examples of how investing in yourself can lead to earning a higher income or starting a new business. 1. Education and skill development. Taking online courses or obtaining certifications in high-demand areas such as data analysis, digital marketing, or computer programming can significantly boost your job prospects and salary potential. Learning a second language could open doors to positions in international trade or global services, which often come with higher pay due to the need for bilingual or multilingual employees. 2. Professional networking. Attending industry conferences, joining professional organizations, or even reaching out to mentors can lead to opportunities that might not be publicly advertised, such as high-level jobs or lucrative partnerships. 3. Health and well-being. Investing time and resources into a fitness regime or a healthier lifestyle can increase your energy levels and productivity, leading to better performance at work and the potential for promotions and salary increases. Mindfulness and stress management practices can improve decision-making skills and focus, which are crucial for career advancement. 4. Side projects and hobbies. Turning a hobby into a side business, like starting a blog, a YouTube channel, or an Etsy shop, can provide an additional income stream and potentially grow into a full-time business. Developing an app or a piece of software in your spare time could fill a niche market need, resulting in a profitable enterprise. 5. Financial literacy. Improving your understanding of personal finance, investment strategies, and market trends can enable you to make more informed decisions, leading to better management of your finances and investment portfolio. Innovation and entrepreneurship. If you have a business idea, investing in market research and a business plan can lead to the launch of a startup. Venture capital or angel investment can then help scale the business, potentially creating significant wealth. Pursuing an MBA or other entrepreneurial training can provide you with the knowledge and network necessary to start and grow a successful business. Each of these examples involves an initial investment of time, effort, or money, but the potential return on that investment can be substantial, both in terms of monetary gain and personal satisfaction. Investing in yourself is about building a foundation from which all forms of success can grow, and that wraps up our guide to starting your investment journey. Remember, whether you're putting your dollars into the market, into a new skill, or into your well-being, every investment in yourself is a step towards a richer life in more ways than one. If you found this video helpful, give it a thumbs up and share it with someone who could benefit from these tips. Don't forget to hit that subscribe button and the notification bell. It helps support the channel and keeps you updated on all the latest content to empower your financial future. Investing is a path, and we're in it together for the long haul. So stay tuned, stay informed, and let's grow our knowledge and our net worth, one smart decision at a time. See you in the next video.